Ford just halted all exports to China. The auto industry's breakout year wiped out overnight. And behind it all, Trump's 25% auto tariffs have detonated a $108 billion cost bomb across the U.S. car industry. General Motors is bracing for a $5 billion hit. Stellantis pulled its entire forecast. And now China's threatening to cut off the rare earths that power America's electric vehicles. This isn't about protecting jobs. It's about whether the industry survives at all. And the next move could shut the system down. Ford's suspension of vehicle exports to China marks a critical fracture in global auto trade. According to the Wall Street Journal, Ford exported only 5,500 vehicles to China in 2024, down from over 20,000 in previous years, due in part to surging tariffs that now reach 150%. That means a $42,000 Ford F-150 Raptor suddenly costs Chinese buyers over $100,000, rendering it commercially obsolete. While Ford continues to export engines and transmissions to its Chinese operations, the halt in finished vehicle exports signals not just retaliation from Beijing, but a shift in economic calculus. Ford Vice Chair John Lawler told Reuters that the company earned roughly $900 million in operating profit from China last year. But now even that may be in jeopardy as Beijing prioritizes local brands and restricts American imports. Yet if Ford's China sales were already shrinking, down from 1.3 million vehicles in 2016 to 400,000 last year, does this pause reflect strategic withdrawal more than short-term disruption? And if so, what's the next domino to fall? Buick's recent momentum was real. First quarter 2025 sales rose nearly 40%, driven by strong demand for the Encore GX, Envista, and Envision. But that entire lineup is now at risk, not because of performance, but geography. The Encore GX and Envista are built in South Korea, the Envision in China. All three are now subject to crushing import duties, 27% for South Korean models, and nearly 50% for Chinese-built ones, according to updated U.S. tariff schedules. That pricing surge translates directly into sticker shock at the dealership. One unnamed auto executive told Bloomberg, "This changes everything for Buick. We're not just raising prices, we're losing customers, who were finally coming back. Dealerships are already reporting inventory holdbacks and slowing pre-orders. And with no clear exemption path in place, Buick risks not just stalling, but unraveling. If tariff-driven supply barriers undercut its only high-growth segment, what's left to carry the brand forward?" The 150% import tariff imposed by China wasn't just a blunt instrument, it was a calibrated rejection. It targeted Ford's most high-profile, high-margin exports, the Mustang, Bronco, Lincoln Navigator, and F-150. According to Ford's 2024 filings, those models represented the brand's symbolic presence in China, where the F-150 retailed for over $100,000 before the latest tariffs. Ford's abrupt pullout, confirmed by a company spokesperson in global data, was less a protest than an economic inevitability. Yet while vehicles are gone, parts still flow. Engines and transmissions made in the U.S. are still being sent to Chinese plants. And Ford continues importing the Lincoln Nautilus from China. This contradiction reveals the underlying issue. Globalized production can't be neatly segmented by trade borders. If tariffs aim to isolate, but supply chains remain integrated, is this really about decoupling or something more fractured? Facing 25% auto tariffs on US-bound vehicles, Japan has proposed a trade swap that's raising eyebrows. Increased imports of American soybeans and rice in exchange for tariff relief on Toyotas, Hondas, and Nissans. Tokyo's urgency is understandable. Japanese automakers exported over 1.5 million vehicles to the US in 2024, and the new tariffs could add $3,800 to $6,200 per vehicle depending on model and category, according to S&P Global Mobility. Japanese officials met with President Trump this week, and sources close to the talks told Bloomberg the proposal is being seriously considered. The gambit, food to save cars, highlights the strategic weight of U.S. agriculture in trade diplomacy, but also the desperation among foreign automakers. Meanwhile, Japanese automakers are quietly scaling back U.S. shipments and front-loading exports to avoid long-term exposure. But if a deal isn't struck soon, Tokyo warns economic consequences will follow, raising the stakes far beyond agriculture. Despite halting vehicle exports, Ford hasn't severed ties with China's market, far from it. The company continues shipping U.S.-built powertrains to China and still imports the Lincoln Nautilus from its Chinese plant to the U.S., sidestepping expectations of a total decoupling. These moves suggest that while finished vehicle exports are politically vulnerable, core supply chain links remain operational. According to an internal memo seen by Reuters, Ford is maintaining this selective engagement to preserve margin in key models and navigate localized production bottlenecks. However, with Chinese tariffs firmly in place, even these channels are under scrutiny. Ford's operations in China generated $900 million in operating profit last year. But if protectionist policies escalate, maintaining this balance may no longer be tenable. The mixed message, pull vehicles, ship engines, raises the question, is Ford restructuring for resilience or reacting on borrowed time? Because while headlines focus on tariffs, the real threat is compounding silently in supply chains. According to a May 2025 report by the Center for Automotive Research, Trump's 25% auto import tariff could raise U.S. manufacturers' operating costs by $108 billion in 2025 alone. That figure doesn't factor in secondary price shocks from tariffs on engines, wiring harnesses, fasteners, and components. Ford CEO Jim Farley told NPR, "We can't even source domestically." Inventory delays are already rippling through logistics networks, with Stellantis pulling its financial forecast and GM warning of a $5 billion hit this year. Meanwhile, sales surges fueled by preemptive buying are masking what could become a steep third-quarter drop. So let me ask you this. When the backstock dries up and the new prices kick in, will American buyers absorb the cost, or will they abandon the lot entirely? Uncertainty has paralyzed industry forecasting. Stellantis, which owns Jeep and Chrysler, pulled its 2025 guidance entirely, citing extreme volatility in tariff enforcement and supplier access. GM reported a strong Q1 but warned of $5 billion in new annual costs, directly linked to parts sourced from South Korea and exported to U.S. factories, per Bloomberg. Mercedes-Benz, though shielded slightly by its Alabama plant, said it may expand U.S. production, but stopped short of new investment, citing unworkable instability, according to CFO Harold Wilhelm. Automakers are now operating under provisional customs exemptions, many of which expire within 2 years. S&P Global notes that over 47% of vehicles sold in the U.S. last year were imported or assembled using cross-border components. As trade policy remains a moving target, the inability to forecast isn't hesitation, it's survival instinct. President Trump's push to bring auto jobs back to U.S. soil has triggered unexpected consequences. General Motors expanded truck production in Fort Wayne, Indiana by 50,000 units, but simultaneously cut shifts in Canada. Mercedes is evaluating capacity in Alabama while freezing expansion in Germany. According to Art Wheaton, labor economist at Cornell University, this isn't new job creation, it's geographic reshuffling. And even that's limited. Building a new U.S. auto plant takes years and billions. In the meantime, UAW workers are facing mounting pressure. Although the union has publicly backed tariffs as pro-worker, internal memos reviewed by Reuters show concerns over supply chain gaps leading to furloughs. With 49% of U.S. car buyers depending on imports, the promise of reshoring is up against steep math and ticking timelines. Tariffs aren't just squeezing traditional automakers, they're throttling the EV supply chain. Lithium, cobalt, and rare earth elements, critical for batteries, are largely controlled by China, which has hinted at export restrictions in retaliation. According to the International Energy Agency, China refines over 70% of global lithium and 85% of rare earths. If Beijing follows through, U.S. battery production could face material shortages by the third quarter, stalling output across Ford's EV line, GM's Ultium cells, and even Tesla's Nevada operations. Ford has already delayed multiple battery procurement contracts, citing unfavorable import costs, per a leaked supplier letter. And with EVs relying on more foreign-sourced parts than internal combustion vehicles, the inflationary impact could be severe. As one analyst from Goldman Sachs told Bloomberg, "This isn't just a tariff problem. It's a gridlock on the green transition." Trump's recent executive actions provide short-term flexibility, allowing firms to claim reimbursements on duplicate tariffs and exempting USMCA parts. But automakers say the patchwork approach adds new complexity. Ford's Farley told NPR, "We welcome the temporary runway. But sourcing alternatives inside the US still makes vehicles thousands more expensive." While domestic content rules were eased slightly, allowing 15% non-US parts for now, analysts warn this merely defers the inevitable. The Wall Street Journal reports that most automakers have not altered long-term sourcing contracts, fearing volatility. Treasury Secretary Scott Bessent says the exemptions are meant to provide runway, but suppliers remain unconvinced. Deloitte's latest industry report shows that only 12% of auto manufacturers expect to significantly shift sourcing within 2 years. So while the White House may be trying to ease pressure, the ground beneath the industry is still unstable. The real test isn't how the industry adapts in the second quarter. It's what happens if these tariffs become permanent policy. According to the Center for Automotive Research, even modest extensions could trigger production relocations out of the U.S., especially for foreign-owned plants in Kentucky, Alabama, and South Carolina. Meanwhile, dealership markups are already climbing. Edmunds reported a 3.2% average retail price increase on imported vehicles since March 2025. Financing rates are creeping up as well, compounding pressure on consumers. If this trajectory holds, affordability may collapse before supply chains do. And that's before factoring in retaliatory moves from the EU, Japan, or South Korea, each of which is currently weighing targeted duties on U.S. agricultural and tech exports. As of May 2025, 17 major trade relationships remain unresolved. So the real question isn't whether the system will absorb the tariffs. It's whether the system as we know it can still function at all. This wasn't a tweak in policy. It was a redefinition of the global auto map. The lines between friend and competitor, domestic and imported, are now blurred by tariffs, retaliations, and supply chain strain. So where does that leave us? Ford pulled back. Buick's momentum stalled. EVs are cornered. And the very idea of Made in America just got a lot more expensive. But this battle isn't over. Because while the U.S. auto industry adjusts to survive, one question still looms. What happens when the countries America once taxed stop playing by its rules? You'll want to hear what comes next. Because the next chapter could change everything you think you know about global manufacturing. Drop your take in the comments. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.